With inflation ripping higher, you know what's hot right now? I bonds. That's right. Series I savings bonds directly issued by the Treasury Department are paying close to 7.12% right now, but in May, experts believe that that percentage could go to 9.6%. And that's because the inflation numbers that are coming out recently have been higher, 8.5% increase year over year in the CPI report for March. So the expectations are that these I bonds are going to increase the rates. In this video, we'll be talking about what exactly an I bond is, how the interest is accrued over time, how to actually buy these I bonds, and then lastly, the pros and cons of I bonds. The technical definition provided by our friends over at Investopedia is a Series I bond is a non-marketable interest-bearing U.S. government savings bond that earns a combined fixed interest rate and variable inflation rate, adjusted semi-annually. Series I bonds are meant to give investors a return plus protection on their purchasing power. Because with every year that passes, the value of this decreases via inflation. So the purchasing power of this bad boy goes down over time, and it's often known as the stealth tax. Every 6 months, the rate does change, and it will be dependent on what the inflation numbers are. So the higher the inflation numbers are coming in, the higher this total rate is going to be, and vice versa. And when we look at something like investing in the stock market, where the average return is around 8 to 10% per year, or a high yield savings account, which pays around 0.5% right now, and then a checking account, which basically doesn't give you anything, and they just take your money and loan it out, it's no good either. So some other important highlights to consider about I bonds. This is a bond that's issued by the US government, so it is considered lower risk. The maturity for this bond is 30 years, meaning you can hold on to the I bond for 30 years without redeeming it. But if you do want to redeem it earlier, the earliest you can do it is after 12 months. So you have to hold it for at least a year. And if you do that and you redeem the bond before 5 years, you'll end up having a penalty worth 3 months of interest. Instead of getting 12 months of interest, you only get 9 if you redeemed it after a year. There is a limit on how much you can actually buy. You can't just load up $1 million worth of I bonds. There is a limit per person per year. That total limit is $15,000. You can buy paper I bonds, which is up to $5,000 per year, or electronic I bonds, which is through the Treasury Direct website itself, for up to $10,000 each year. And when it comes to taxes, you have to pay federal taxes on the interest earned only when you actually redeem the I bond, and then you don't have to pay any state or local taxes. Speaking of no taxes or tax advantages, I want to talk about the sponsor of today's video, iTrustCapital, which is a crypto IRA provider. Meaning if you're buying and holding cryptocurrency for the long term and you use something like a Roth IRA, when you sell those cryptocurrencies for a gain in the future, you wouldn't have to pay any taxes on it. And you can stick it to the IRS when they're bothering you about your crypto gains. If that does sound interesting to you, make sure to check out the link in the description below. If you do fund an account using that link, you'll also get a $100 bonus. Shout out again to iTrustCapital for sponsoring this video and being a partner with the channel. Let's get back into the video. Now that you have a little flavor on what exactly an I bond is, let's talk about the interest and how it gets accrued. The interest accrues monthly, but it compounds on a semi-annual basis. What does this mean? On a $1,000 investment example at a 12% interest rate, after 6 months, you'd have $60 of interest. If you compounded that interest, that means that you would take that 60, invest it in something else that gives you 12%, and now for the next 6 months, your principal is $1,060, and you would get $63.60 of interest instead of 60 for the second half. You can see how that one compounding increases your interest from 120 to 123.60. When we're talking about that 9.6% rate, that's a yearly number. What ends up happening though is every 6 months, the number does change based on that variable rate changing, and the fixed rate is what stays the same once you buy an I bond. Sometimes the fixed rate will be 0% when you buy it, and you'll never get a fixed rate. It's just locked in for the time when the bond is issued. Whereas if you bought an I bond and the fixed rate is 0.5%, well then you're always going to get the variable rate plus that 0.5%. Speaking of fixed rates within the I bond, there hasn't been a percentage since November 2019. And then if we look at the composite rates by the issuance, we'll see that 7.12, 7.12. These are all the same. So if you bought a I bond in May 2020 and are still holding it, you're getting the same rate as someone that bought in May 2021. These rates that are higher, it goes back to this fixed rate that is also included. So if you had a time travel device and you went back to 1998, your composite rate could be 10.64% if you were still holding on to those I bonds. Of course, that's a super lame way to use a time traveling machine. Plus, you should be buying Apple stock or something, not I bonds. You've probably come to the conclusion that without a higher variable rate, these bonds would pay very little. With the 0% fixed rate, 100% of the returns on the I bonds that are being bought right now is based on the inflation rate. If that goes down, then the returns over time will also shrink. So you're not locking in 9% forever. It could potentially only last at an elevated level for a couple years. What's good to know is if we do go into a deflationary period and have negative inflation, your percentage for the I bond is never going to go below 0%. So it's never the case where you actually have to pay the government for owning the I bond. So we know the higher return is the appeal for I bonds, but what are some of the drawbacks? The first one that comes to mind is opportunity cost. If inflation is higher and the stock market is getting pummeled or there's a drawdown, if you took that $1,000 and actually put in the stock market, you actually may get a higher return than that 9.6%. Of course, that isn't guaranteed, but it is possible. Another downside is liquidity. So if you needed the money in the next 12 months, locking it up in I bonds isn't probably smart because you can't touch it until 12 months pass. Lastly, the penalty. So the redemption penalty that we talked about earlier, if you redeem it before 5 years, you lose 3 months of interest. If we look at something like that 7.12% rate and it's compounded semi-annually, if you got rid of 3 months of interest, your total return would actually be 5.3%. But then again, even with that penalty, it's still higher than something like a high yield savings account. If you don't need the money, you're still winning. Now that you have an understanding of what I bonds are, some of the drawbacks, how do you buy these things? Well, there's two ways. There's buying paper I bonds, and this has to be done through a tax refund. It's a weird system, I know, but they can be bought up to $5,000 through this IRS form 8888. Using this form, you can allocate the refund that you get from your taxes. Instead of going to your bank account, it would go to buy I bonds. I don't know who came up with this system, but if you're not getting a tax refund, you can't even use this method to buy paper bonds, and there is no way to go around it. Also, when you do that, you can file it in someone else's name and give it as a gift, but so as long as that person isn't going over their own personal limit of that $15,000 limit per year. If you're married and file your taxes together, you can only buy up to $5,000 worth of I bonds, not $10,000. It's per tax filing. And then the second way to buy I bonds is electronically, and this is way easier in my opinion. You go to the Treasury Direct website, you create an account using your tax ID, email address, and so as long as you're a U.S. resident, even if you're a U.S. citizen abroad or a civilian employee of the U.S., you can open an account. And then for people under 18, you would just open a custodial account. And for those wondering, there are no fees. You may be wondering, in what situation would I personally use I bonds? And it is very specific for me. I think if you have an emergency fund and it's overfunded past 12 months, the difference, let's say you have 18 months worth of cash in a high yield savings account, you can take 6 months of that and put it in something like an I bond and get a higher rate than something where you need the liquidity in a high yield savings account. Even with the penalty of 3 months, you're making out better on that money that's just sitting. Now, if I'm comparing just I bonds versus something like an index fund, S&P 500, I'm going to be buying stocks 100% of the time just because I'm a bit more aggressive, I'm younger, so I can take the higher risk. Because if you do strip away that variable rate from I bonds and let's say inflation is lower, well then your return on I bonds are going to be low. Whereas if you're in that stock market fund, you can be getting on average that 8 to 10%. Also, if you're trying to time the market by being in bonds and then selling them and then rotating into stocks, if you're too slow to do that, miss out on a few months of stocks rallying, there's your opportunity cost that we talked about earlier, and you would have been better off just holding stocks. I know bonds are definitely a drier topic, but with the higher rate, hopefully it's a little bit more interesting. Hopefully you learned something. And if you did enjoy the video, make sure to hit that like button and consider subscribing to Main True Wolf, where we talk investing, anything to do with money. Thanks guys for watching and have a great day.